Right now, there's a choke point halfway around the world that could decide whether your retirement stays on track or gets derailed. And if you're over 50, the next few decisions you make might be the most important financial moves of your entire life. I'm not being dramatic. I'm going to walk you through what's actually happening, why it's showing up in your portfolio even if you've never owned an energy stock, and most importantly, 4 specific moves you can make this week to protect yourself and possibly come out ahead. Stay with me because strategy number 3 involves a little-known provision in the tax code that most people miss, and it can make a real difference. Let's start with what's going on. The Strait of Hormuz is a narrow strip of water between Iran and Oman. At its narrowest point, it's only about 21 miles wide. It connects the Persian Gulf to the open ocean, and it's the only exit for roughly 20% of the world's oil supply. That's about 21 million barrels moving through that channel every single day. Saudi Arabia, Iraq, Kuwait, Qatar, and the UAE all rely on it. When tensions rise in that region, global energy markets don't wait to see what happens. They react immediately. And that's what we're seeing. Military activity, political brinksmanship, and uncertainty around shipping safety have pushed insurance costs for oil tankers higher. Traders are pricing in disruption risk. Even without an actual shutdown, the possibility alone is enough to move prices. Those higher prices don't stay confined to oil futures. They ripple outward, straight into household budgets and retirement accounts. Here's the chain reaction most retirement planning articles never spell out clearly. When the Strait of Hormuz looks risky, oil prices tend to rise. When oil rises, transportation costs rise. Gas gets more expensive. Shipping gets more expensive. Manufacturing inputs get more expensive. That pressure spreads through groceries, goods, and services. That's inflation. When inflation looks like it might stick around, the Federal Reserve faces pressure to keep interest rates higher for longer, or even raise them. And when interest rates rise, bond prices fall. That part isn't opinion, it's math. Now think about what that means in real life. If you have a $700,000 portfolio and markets drop 10% in a short period, that's $70,000 gone on paper. If you're 5 years from retirement or already drawing income, that doesn't feel abstract. It feels like the floor just shifted under your feet. This is why people in their 50s and 60s feel this kind of shock more than anyone else. Your portfolio probably has a higher bond allocation than someone younger. Bonds are supposed to be the stabilizer, but in an inflation-driven environment, stocks and bonds can fall at the same time. That's a double hit to a portfolio that was built to be conservative. You're not doing anything wrong. The environment is just difficult. Before you do anything drastic, you need to hear this. Geopolitical shocks, even serious ones, are not the same thing as structural economic collapses. History is very consistent on this. When Iraq invaded Kuwait in 1990, the market dropped about 16%. It recovered within 6 months. After September 11th, markets fell sharply, then recovered to pre-attack levels within weeks. These events were terrifying in real time, but markets eventually absorbed them. There's also something meaningfully different about today compared to earlier decades. The Federal Reserve responds faster and more aggressively to external shocks than it used to. We saw that clearly during the pandemic. The Fed used tools that didn't even exist a generation ago, and it moved with a speed that surprised almost everyone. That doesn't mean markets can't fall, and it doesn't mean every problem disappears, but it does mean that downturns driven by external shocks tend to be shorter and less destructive than many people fear in the moment. The worst possible move right now is panic selling. Selling in fear locks in losses permanently. You can't rewind that decision. Instead, let's talk about what you can actually control. I have 4 strategies for you, and all of them are practical. Strategy number 1 is to build a cash cushion, and do it deliberately. This isn't about pulling your entire portfolio into cash. It's about making sure you have enough liquid money to cover essentials, so you're never forced to sell investments at the worst possible time. Start by listing your monthly necessities: housing, food, insurance, utilities, medications. Even 3 months of coverage makes a real difference. 6 months gives you real flexibility.
Where does that money live? A high-yield savings account is the simplest option. They're FDIC insured and still paying competitive rates. Treasury bills are another strong choice, backed by the U.S. government. You can stagger maturities so money becomes available regularly. The goal isn't perfection, the goal is breathing room. Every dollar in that cushion is a dollar of freedom, letting your investments recover on their own schedule instead of being liquidated under pressure. Strategy number 2 is to turn paper losses into a real tax asset. If you have a taxable brokerage account, not a retirement account, and some holdings are down, you may be sitting on an opportunity. By selling those positions, you can realize the loss for tax purposes and immediately reinvest in something similar so you stay invested. Here's how it works. Capital losses offset capital gains dollar for dollar. If losses exceed gains, you can deduct up to $3,000 against ordinary income this year. Anything beyond that carries forward indefinitely. It doesn't expire. You're converting volatility into a permanent tax benefit. There's one rule you must respect, the wash sale rule. You can't sell a security and buy the exact same one back within 30 days, but you can sell one broad index fund and buy another that tracks a different index with similar exposure. That keeps you in the market without violating the rule. One near-retiree trap to watch closely is automatic reinvestment. If you sell a fund at a loss in a taxable account, but that same fund is being automatically purchased inside your IRA or Roth, even through dividends, you can accidentally erase the deduction. Before harvesting losses, check all accounts and turn off automatic reinvestment if needed. Strategy number 3 is a once-in-a-career window for people aged 60 through 63. This is one of the least understood changes from the Secure Act 2.0. If you're in that age range and your employer plan allows it, you can make a significantly larger catch-up contribution to your 401k than at any other point in your life. In 2025 and beyond, that total can be substantially higher than the standard limit. Why does this matter now? Because contributions during a market downturn buy shares from a lower base. When markets recover, those shares rise from a lower bottom. If the contribution is pre-tax, you also reduce your taxable income today. Planners often describe this as one of the most efficient wealth-building windows available to early 60 workers. This window is narrow. At 64, it closes. If this applies to you, call your HR department this week and ask whether your plan supports the enhanced catch-up and how to implement it. Don't assume it happens automatically. Strategy number 4 is to hedge inflation directly. If energy-driven inflation is your biggest concern, consider tools that are built specifically for that problem. Treasury inflation-protected bonds adjust their principal based on inflation. When prices rise, the bond's value rises with them. That's exactly what they're designed to do. I-bonds are another option. Their interest rate is tied to inflation, and they're meant to preserve purchasing power, not to speculate. They're not exciting, but in periods of inflation stress, boring can be very effective. Now, let's quickly cover the mistakes that hurt people the most in moments like this. Don't move everything to cash. That locks in losses and almost guarantees you miss the recovery. That's not caution, that's surrender. Don't stop your retirement contributions if you can help it. You lose the employer match, the tax benefit, and the chance to buy assets at lower prices. If cash flow is tight, reduce contributions slightly, but don't shut them off entirely. And don't try to time the bottom. Nobody does this consistently. The most dangerous sentence in investing is, "I'll get back in once things feel calmer." By the time things feel calm, markets have usually already moved. Here's what I want you to take away. Yes, the situation around the Strait of Hormuz is real. Yes, market volatility is uncomfortable. But external shocks don't last forever. Systems adapt, recoveries happen. The people who come through these periods strongest aren't the ones who predicted the crisis perfectly. They're the ones who stayed disciplined, protected their liquidity, used tax rules intelligently, and kept contributing when it felt hardest. You don't need to solve everything today. Just take the next right step. Check your cash cushion, review your taxable account. If you're 60 through 63, make that call to HR. Those actions matter far more than watching oil prices every hour. This will pass. Stay steady, use the tools available to you, and let this moment strengthen your financial foundation instead of shaking it.